Good morning, everybody. It's Trent Klarenbach with Klarenbach Research. Today is September the 5th, 2024, and today I will share with you some few charts regarding the bond market. And I'll look at the T-bond futures trade on Chicago and at a ratio charts comparing them to the stock market. So the first chart up here is the weekly T-bond futures chart, and you can see here that the 125 level has been acting as resistance for the last month and a half. Now, it also was resistance back in December 23 and support throughout the early first half of 2023 also. So not surprisingly, previous support often acts as resistance, and we're seeing that here too. Now, this blue line here is the anchored volume weighted average price, and I have that anchored back in March of 2022, and that was a high back then. It's also the last time the purple 200-week moving average was tested, and actually at that time too, we've seen the crossover between the 50-week moving average, the green 50-week moving average, and the purple 200-week moving average. So not surprisingly, this level is acting as a level of resistance. Now, if bond futures start trading above this level, then we start looking at the next VWAP, which goes back to August of 2021 and represented by the yellow line here, which obviously coincides again with the resistance in March of 2023 and support in June of 22. If we start looking at this is the 20-year Treasury bond ETF, the TILT, versus the Dow Jones Industrial Average ETF. This is what's going on here. We're finding some consolidation here throughout the last half of 2024. We saw it broke above this green 50-week moving average, and now we're testing it again here. This consolidation suggests that perhaps this could be a stage one accumulation, and what follows a stage one accumulation is a stage two markup. Now, I think it's too early to announce the arrival of a stage two markup, but keep an eye on this chart because we're starting to see some consolidation here, and if we start making some higher highs and higher lows and get above this green 50-week moving average, and we're obviously seeing an acceleration of capital into the bond market relative to the Dow Jones Industrial Average. Now, the bond market is considered the smart money, and if they are the smart money, then we have to ask ourselves, why are they allocating capital into the bond market faster than the stock market? Now, that's not happening yet, but we want to be aware of that potential happening, and when it happens, we want to shift our priorities accordingly. This is the TILT, the 20-year Treasury bond against the S&P 500. I draw some trend lines here. We broke above this trend line back in August. Now we're back testing it again. We'll see if maybe this is the sign of a trend change, and it's a little bit too early, but we want to keep an eye on this. And again, it's the same idea. If bonds are attracting capital faster than the stock market, then we want to be in the bond market. And this is the daily chart of the TILT versus the SPY ETFs, and we can see here this, we broke above this green 50-day moving average, broke above the purple 200-day moving average, came back and tested the 50, and now we're back going to test the 200-day moving average again here, and also that trend line that we've drawn from before. So we want to keep an eye on this. We could be seeing a trend change in the bond stock market ratios. And if that happens, we want to be aware and consider where we're going to reallocate our capital. My name is Trent Klarenbach. It's sunny in Saskatoon. Life's good.